Thanks, Sam, and welcome, everyone. We're certainly talking about one of my favorite topics today, individual retirement accounts, and all of those year-end things that seem to pop up as we try to close out the 2012 year. And remember, the tax year will go on until April 15th, and April 15th is on a Monday this year. And, all of those things that become important before we roll over December 31st, because that's when our reporting will happen, and to make sure all those codings are right and all those contributions were done right. So my thinking was today, because the numbers have changed, we have new cost of living numbers, is that I would give you a good review of the 4 products. And then we'll talk about rollovers and transfers, some of the things to look for there, where things can go wrong, kind of the year-end critical issues. And then we'll talk about premature distributions, required minimums, inherited IRAs, because we're approaching year-end, and those deadlines on those distributions, withholding and some compliance issues, and also I know some of you are concerned about excess contributions and getting those out of the account, so we'll also take some time to talk about excesses and anything else that you want to talk about IRAs. I am a former banker, and I used to work at a bank called Hibernia National Bank in New Orleans, and I left there in 1987, and the way I tell it is I left it when I was 10, but I started doing IRA training for live groups in January of 1988. So I've seen a lot of history with IRAs and a lot of changes with IRAs, but there are some fundamentals and things that become critical to the system, which is basic, that the money goes in and the money goes out and it gets reported to the IRS. So connecting those two is more difficult now, because a lot of times people have outsourced their operations and you're using TRAN codes that you don't always, your frontline doesn't always know what that means. Now, you've got a set of slides, and you've also got your big O operations handbook, so you can track along either way. And I'll try to make sure that I cue it up for you in both ways in case you did print your big handout. So we're going to begin today talking about, on your manual, about the IRA products. There were 2 things that I want to mention right off the bat that are new, and that's, first of all, those limits have changed. So you're going to see new 2013 numbers. So SEPs are going up to 51,000, regular IRAs to 5,500, simples to 12,000, and of course your health savings accounts, for those of you that do those, are going up to 3,250 and 6,450, plus those catch-up contributions. I also want to mention that the IRS is discontinuing their missing persons. So it used to be you could put a letter in a letter and send it off and say, we're trying to find this person, can you forward this to their last known address? But that is going to be discontinued, and so that's in Revenue Procedure 94-22, and that was where it was originated, and of course they're no longer going to be forwarding letters. So that's going to hurt you as far as tracking down these beneficiaries and tracking down your IRA account holders, and so that service is not going to be any longer available. Now, in your big manual, if you printed it, it's not necessary that you did, we'll be on page 8. And we're going to be talking first and giving you a good review about the 2 choices of IRAs for individuals. And the first is the traditional or regular IRA, some people call it, and the Roth. And we know that these IRAs have some things that are in common, and then they have some differences. So let's start by looking at each one of them and then kind of coming back and comparing them. On page 9, we know that in order to have a traditional IRA that started in 1975, that you have to have this thing called earned income, compensation, wages, and that you can contribute 100% of that earned income up to $5,000 and $6,000 for the 2012 tax year, knowing that's going to bump up next year. And we also know on this traditional IRA that in the year that our account holder turns 70 and a half, we can no longer make contributions to the IRA, and that these contributions have to go in by tax due date with no extensions. Now, that's $5,000 for the traditional and the Roth combined. So if your account holder has both a traditional IRA and a Roth, then together they cannot exceed that $5,000. Now, sometimes one of the things that's interesting is kind of this definition on page 10 of your big handout of what is and what is not compensation: wages, salaries and tips, commissions, self-employment income, alimony, separate maintenance, and one of the things that's been added there is that non-taxable combat pay. So all of that counts in. So on page 11 of your handout, you'll see 7, 11, 12, and 18 are circled on the 1040, and those are the things that are considered earned income. And of course, if it's non-taxable combat pay, then your account holder is going to know what that is and how that becomes eligible. Again, in by tax due date, no extensions here on this traditional IRA. One of the things that you guys might remember about this is that there is a spousal IRA, meaning as long as you're married, filing a joint tax returns, and both the husband and the wife can have a spousal IRA. So we know that people buy this IRA because quite often they want that tax deduction. You want to take your benefits up front, pay your taxes down the road when you hope to be in a lower tax bracket, and so this IRA tends to be front-loaded. So whether or not that they can deduct this IRA has to do with some very specific things, and that has to do with whether they have a qualified retirement plan, whether their spouse has a qualified plan, and then, of course, they have to look at how much they make and their filing status, and all of that is outlined for the account holder in publication, IRS publication 590, how much they can make. So we come into this thinking then that there's three kinds of savers kind of for retirement. There are people probably like you that save in your 401k plan. And then there are people like me who are self-employed, and we save in our IRAs and our SEP IRAs. And then there's probably a group in the middle, very smart group in the middle, and they save both in their 401k plans and in IRAs. And that's the group that's affected. If you have a retirement plan at work and you have an IRA, that's when you have to look at these income limits. Do you have that qualified plan where you work? So this traditional IRA that started in 1975 was designed for people who basically wanted a way to have their own retirement plan because they didn't have one at work. In the old days, I always like to say in the old days, they were $2,000 and everybody got a deduction. But of course that has changed as time goes on. So you begin your contribution when the account holder has earned income, and the day that they turn 59 and a half, they can begin distributions without penalty. And then, of course, in the year that they turn 70 and a half, they can no longer make contributions to this. Now, one of the key things about this, and I guess I've had probably 10 emails on this very issue in the last couple of months, has been to make sure we get the traditional IRA into the traditional IRA reporting boxes and the Roth IRA into the Roth IRA reporting boxes. So you're going to see in your long handout there, you'll see on page 13 that we report the traditional IRA on a 5498 in box 1, and we put $5,000 in there, and in line 7, it'll say IRA. One of the recent calls I just had on a missing and kind of a mixed-up code, it came about because originally the IRA was opened as a Roth IRA, and then about 3 years in, somehow the bank started reporting it as a traditional IRA, and I'm guessing that's probably when the CD renewed. And so for 3 years it got reported as a Roth. Now it's been reported as a traditional. And when the customer came in to cash out the plan, then they find out, oh, no, we've got errors here, and what do we have to do? Well, what do we have to do? We have to go back and correct the reporting for all these years and then make sure we do the distribution reporting out of the right IRA. And sometimes you wonder, why doesn't the IRS catch these in a more timely fashion? But the IRS has traditionally been about 3 years behind on these reporting issues when it comes to IRAs, so it's always an ongoing challenge. So our traditional IRA is a savings plan for retirement. They're certainly going to get tax-deferred earnings. It's sitting in there, kind of this holding tank for the future. Possibly a tax deduction depending if you're covered by a company plan and you make a good deal of money.